Good afternoon, everyone. Am I audible to all of you? Am I clearly audible? Please raise the virtual hand. Okay, Rashmi. Thank you. Thank you for confirming. Any doubt, any query related to previous session, whatever we had discussed so far? Anybody who has a doubt? You all have received the recordings? No. Okay. Fine, everyone. So let's begin with the topic, what we had covered so far. We had covered till investment decisions. So we'll take from there only. I'm just going through. So Varna, all recordings are already available in your LMS. What you need to do, you need to check your LMS. Or if it is not reflecting in your LMS, you should connect with the team. Fazal, you have missed previous classes, no problem. What you can do, you can just go through the recording of previous 2 sessions. Fine. And the PDF will also be shared. PDF will be shared with all of you. So you can very well connect with the PDF. And if in case you have any query, any difficulty after going through that PDF, then too you can connect with me through tickets. Okay. Fine, everyone. Just wait for 1 or 2 minutes. Let others also join. So in the meantime, you can type your questions in the chat box. I'll respond to that. Meanwhile, others will also join so that we should not repeat the same concept again once they come. Okay, fine. Priyansh, by tomorrow is the session by which we will complete the basics of finance or the introduction to finance. So by that time, maybe by tomorrow or Monday, it will be uploaded to your PDF. LMS. Right. Okay, let me just check one more question and then we'll begin. One of you have mentioned the question in chat box, any relationship to create in personal finance and primary market? What exactly do you want to ask? Is it related to the IPO process or what you want to ask? Anybody can let me know what is the assignment which is mentioned on LMS? Is there any assignment which is showing to all of you, which I'm not aware? Okay. Okay, Pooja. Fine, fine. I'm just switching off the video for the correct bandwidth and all. Okay, I hope there is no issue. I am switching off the video. We'll continue to discuss questions, right? No. W is different, Mohammed. That is not part of this course. That could be additional things that you can take care of with the discussion related to your career coach, right? Okay, fine. So let's come back and we'll discuss about the investment decision. Okay, fine. So investment decision. Yes, sir, if you have raised hand. Okay. So what is investment decision? Here we are talking about the perspective of organizations. These organizations are investing in the project, which you call as a corporate. So corporates are investing in different project. How do they invest in different project? They need to analyze which project is feasible for them, which project will fetch more value. risk-adjusted return will be higher in that project. So what they are looking for, that they are determining the total amount of assets which are held in a firm and the composition of these assets as a business risk. What does that mean? Means risk complexities are also taken care of. Let's understand it in a simple perspective once it comes to personal finance. What we do once we are investing in a different instrument, we try to analyze the return, which instrument is going to give us higher return. And not only the higher return, but risk adjusted return. So here also, as a corporate, what they look for, there should be risk adjusted return, right? Now, we are talking about three decisions: investment decision, financing decision, or what is the third decision we had discussed? We discussed about three important decisions in finance. One is the financing, one is investment. What is the third decision? Dividend, right? Right, Kevin. Everyone. Fine, Prachi. Okay. So most important finance decision, because fund are involving cost. And this cost is what? Whether it is, if we talk about the capital structure, it could be debt, it could be equity. So there is a cost associated with equity, cost associated with debt. What is the cost associated with equity? We'll quote one example. This is the way they can raise fund, either equity or debt. In case of equity, what they want, what as an investor, we want higher return. So rate of equity or the cost of equity will always be higher than debt. Right? So here, in case of debt, what is going to happen? What is the bond yield? It could be 8%. At least it will be below 10%. 8 to 10%, 7 to 10%, this will be the debt return. But is equity return similar? No, equity return will always be higher. Means cost of equity for a firm will be higher than cost of debt. So usually we say that debt is cheaper than equity, and debt comes with tax shield also. Once we calculate WACC, weighted average cost of capital, we say equity, cost of equity multiplied by weight of equity plus cost of debt multiplied by weight of debt. And with this debt component, we multiply it with 1 minus t. That is the tax shield. Okay, let me take the questions. Okay, you all are still writing the answers. Is there any time lag? Because I'm receiving the dividend answer. Right now, someone has written. I hope there is no time lag, no? Okay, so I was explaining about this equity and debt. With the exams, a small example we are discussing about cost of equity is higher than cost of debt. So here we are talking about important decision, how they are going to take this decision. Optimum capital structure should be there, a judicious mix of debt and equity. Capital structure point also we'll discuss. So funds involve cost and these are limited quantity. Right? It's not an ample amount of funds which are available. For example, if any corporate wants to raise money via bond, so they know how much is the amount which is raised by them. It cannot be over allotment. Over allotment cannot be done for in terms of bond. If the authorized capital in terms of IPO shares, authorized capital is, they cannot overdo it. That will be limited. If they are authorized to raise, let's say 1,000 crore, they cannot exceed that. They cannot go beyond that. They are supposed to raise this, and they can raise it in different tranches. It's not necessary they can raise the entire amount at one go. That is why it's a authorized capital and then issued capital. How much they issue? Part of that, if they are retaining them, it is non-issued capital. So next time, once they go with follow-on public offer, they issue that part which is still left. Out of that entire authorized capital, whatever they have not issued can be issued in further round. No, Paras. I'm not saying it's less risky. I'm saying less costly. It's cheaper as compared to equity. It is risky also. What is going to happen if we talk about if you are talking from the perspective of investors, for us, equity is risky. We say debt is less risky. But that depends which category of debt we are looking for. I'm taking your question, so quoting one example for that from the perspective of investor. Let's say I have two options to invest. One is equity and another is debt. For equity, what is going to happen? I am expecting a rate. Let's say the Nifty is giving 12 to 13% or 12 to 14% return. I'm taking a random number. Let's say 12 to 13% return, which is index return. It's not sure that the in which stock I'm investing that will also replicate the interest of Nifty. So what I'm trying to say is the expected return in equity is higher, and that comes with risk. Risk is also there. I might get this, I might not get this. I might get 6 to 7% or even below than that. What happens with debt? This example is from the perspective of investors, right? I'll take another example to explain from the perspective of corporate as well. So debt, in case of debt, what I'm explaining, bonds. I'm investing a bond. It has different categories based on the rating, based on the credit rating of a bond. You are aware about AAA, AA plus. Yes, Arjun, debt is cheaper than equity. From the perspective of corporate, that is cheaper than equity because that comes with tax shield. Okay, so here, and they are not diluting the ownership. For equity, what they need to do, they need to dilute, they need to sell the ownership part. Now, whatever share they have raised via IPO and which is available for trading in public domain, they are not the owner of that. Investors, you and I who have purchased those shares are the owner now. So here the ownership is diluted. But in case of debt, it is not. Debt is kind of loan. The money which they have raised via issuance of bond, it is just like a loan. Once the tenure is completed, they will pay the par value or the face value, and the relationship between the investor and the bond owner, or that means the issuer of the bond, is completed. Right. So I was explaining about the rating here. This is AAA, AA plus, BB, D. These are the rating. There might be certain variation in terms of rating from certain rating agency, just like CRISIL, ICRA. You might find this in some of the rating agency. There could be a little variations. Okay. So now talking about this, these are considered as investment grade. What do you mean by investment grade? These are safe to invest, means the financial condition of company is fine, company is financially healthy, and we can invest. Means there are no chances of default or very less chances of default. Now coming to this category D, it is considered as junk bond or default grade. That means it is having high degree of risk. If I'm investing in that bond, why will I invest in that bond? Because the issuer of this category of the bond promised to pay higher rate of return. That is why it is also called high yield bond, D category bond, below investment, junk bonds. These are high yield bond. They promise to pay higher rate of interest, but they might default because the company who are raising money via issuance of these bonds are struggling. If they are struggling, they are not financially well, they might default. Okay, so here I have taken the example from the perspective of investor. Now, let's say I am investing in AAA category bond, so the rate of return or the yield, bond yield will be, let's say 8%. So as we go down, the yield will be higher because the risk associated with these bonds is high. They might promise to pay 11% more than this. Then only the investor are willing to invest in that bond. If they are willing to take high degree of risk, like money might go into waste, but then too, they are willing to invest, they are taking high risk. So here, with the security, with the secure investment, the returns will be low. So we are sacrificing the interest in these categories of bond because we know that these are safe, AAA category. Similarly, if we talk about the GSEC, government security, it is considered the safest among bonds. So that also provides less return because safety is there. Now coming to equity part here, it is not guaranteed. Now here from the corporate perspective, corporates are aware that what is the future obligation? They need to pay, if it is for 5 years, they need to pay 8% on annual basis as an interest. And here, if they have borrowed 100 rupees, At the end, 100 rupees will be paid and these 88 rupees per year. So they know about the future obligation. This is cash outflow is certain to these corporates. If equity is there, number one, ownership stake is diluted. Number two, the rate of return will be higher. How do we compute the expected rate of return on equity? That should be more than risk-free rate. I'll give the formula also, I'll tell you, but here I don't want to dig into detail and don't want to confuse others. Some of them are newcomers. So through CAPM formula, also some of you who are aware can easily connect with it. But I'll discuss this in detail later and I'll describe each and every factor so that you should understand how to compute the expected rate of return on equity. So this is through capital asset pricing model, which is widely used. So RF is risk-free rate plus beta, then market return minus risk-free rate. This is also called market risk premium. So how much additional return I'm deriving, which is more than risk-free rate, that is multiplied by this risk factor beta, and we'll add this in risk-free rate will give us a return, which is expected rate of return for an investor, and this is cost of equity for that corporate. See, Dheeraj, what I'm speaking is answering certain questions which might not be included in PDF. But yes, if you have further doubt, you can multiple times you can ask the same question. I will respond during the sessions. No issues for that. Okay, this is for answering for one question as one of you have asked. So I'm replying to that. This is not mentioned. Whatever you can see on a screen, that will be available to all of you. Okay, these are certain additional things which is spontaneous, which comes during the sessions. Okay, fine. So let me erase this. So we have discussed about the costing perspective. Now moving to another aspect, that is about the long-term and short-term decision. Pooja, you have raised hand. Is there any query, any question? If you have any question, you can write in chat box. I'll respond to that. Whoever is not having any question, yes, Joyce and you also. Please lower your hand. Joyce, I can see your hand, but you haven't. Okay, okay, no issues. We have just started discussing about the investment decision. You can type your questions, or by tomorrow or by Monday, the PDF of the session will be uploaded in LMS. You can go through that. Some of them who have joined late, who have not attended the session, I suggest you all to go through the first two recordings. In those first two recordings, if anything which is not clear to you, you can discuss it with me in the next live session, or through the ticket also you can write the question to me. I'll respond to that. Okay. So let's come back to the point which we were discussing. We were discussing about long-term and short-term decision. So how many of you are aware about what a long-term decision and what a short-term decision? Right? In chat box, what according to you, what is the tenure specifically in long-term and short-term? Monisha, I'll come to your question. I'll discuss it. Let's first discuss about these two parts which I asked, then I'll explain you about the equity also. Okay, most of you are writing short term. Yes, Prachi. Short term, we are talking about here, since we are discussing about the investment decision from the perspective of corporate and capital budgeting. Long term decision will be greater period. A short term within 1 year period, that will be for what is the purpose behind short term? That is working capital management. And this long term and short term has different meaning. I'm not saying you all are writing wrong 12 months or this. Yes, it is daily. One minute. Let me just read the answers for most of you so that it should be an interactive session. I'm just reading the answer. Most of you have written about 10 years is for long term, more than 5 years, someone 10 to 15. Ayushman, you have written more than 12 months long term. Okay, more than 1 year, fine. Then 1 to 2 year, 5 to 15 short. See, there are different definition. The point is for which perspective we are thinking about. Okay, long term, more than 5 years, or it could be 10, anything beyond 5 years. But if we talk about working capital management, that is about managing their regular requirement for a business. What could be these requirement? Mean salaries or payment to the raw material suppliers, payment to suppliers, or certain rent. These all will come for the working capital requirement. So these are short-term decisions which are considered as less than 1 year. Yes. Yes, rent. That's what we discussed. Rent and other miscellaneous expenses, which we call as the electricity expenses, rent, and so on. You all have understood about the basic terminology which are used for working capital requirement. Okay, now, as you all have written about short-term and long-term, I would like to explain here only, although we'll discuss in fixed income security, but as short-term, long-term, ultra short-term, how does it considered in fixed income securities? In fixed income securities, below less than 1 year, it is ultra short-term. Then 1 year to 3 year, short-term. Then 5 year, 3 to 5, medium term. 5 to 10, long term, or even more than 12 years will be considered as long term. There are different categories based on the tenure of the bond. In equities, what we consider less than 1 year, more than 1 year is specifically for the purpose of tax purpose. Less than 1 year, short term capital gain, and more than 1 year, long term capital gain. But in case of debt, it is different. Okay, one of you have asked about equity. Let me just read the question if I missed any question. Who asked about Monisha, I guess. Okay. So what you mean by equity? Equity, we are talking about shares here. That means if there is a corporate, most of you have watched the Shark Tank. This term is very colloquial. This is mostly discussed. Equity, they are sharing their equity. That means the ownership stake. Let's say this is the entire capital, means the 100%. Out of this 100%, if they are coming up with IPO, last class also we discussed, if they are coming with IPO, if they are selling nearly 20%, so that means this 20% will be issued as a shares to investors. This is entire equity. This 100% is entire equity. Out of this, 20% is with investor for the public limited company. Okay, so equity is not means we are talking about shares. And then debt, we are talking about loans or bonds. They have two options. Either they can raise the fund via issuance of equity or debt. Why they require money? They might be requiring money for different purposes. They have a big corporate setup, whether they are into FMCG industry or they are into service industry. Let's take an example of FMCG company. ABC Limited is a FMCG company. It has its presence in, let's say, South India. They want to build another manufacturing unit in North India. So what they do, they will be requiring fund because they want plant, machinery, land, different requirements are there for this expansion of business. What they can do, they can either apply for loan from bank, they can sell certain portion of their equity. Third, via issuance of bond, that is also a kind of loan. Via issuance of bond, what they are doing, they are raising money from public, you and I. You might have heard about different corporates who are raising money via issuance of bond. So they can, based on their project, if they know once they will start receiving the cash, based on that duration, they decide for how long they are going to issue that bond, for 10 years, 5 years, more than 5 years, within 5 to 10 years. So they are quite sure that what will be the future cash outflow in terms of coupon payment. They know how much amount they need to pay and at which particular point of time, which will be always, most of the time it will be less than bank interest rate. Okay, So here we discussed about equity and that part. Manisha, I hope you are clear about the equity portion now. What is equity? Means they are selling their shares. As you can see, different examples with the companies once they are coming up through IPO. What they are doing, they are selling their equity portions. They are issuing it to investors. Now they are becoming the public limited company. Difference, 1 second. Rohit, you have mentioned difference between issuance of bond versus equity. See, that's what I was explaining about. As a corporate, ABC Limited has two options. I am taking broad two category. There are different options as well through venture capital, private equity, and other options are there. I'm taking broad two category, equity financing and debt financing. So in equity financing, what they can do? They can offer their shares to public and those shares will be listed on a stock exchange. Second is what? Debt. Debt is means loan. They can issue bond also. If they are issuing bonds, they are raising money via issuance of bond. They are providing certain interest rate as a coupon rate, which they will be providing to investors at interval. What could be? It could be semi-annual payment. It could be annual payment based on the indenture of the bond. Right? So this is issuance of bond. Mohammed, you have written the rate of equity will be decided. Rate of return on equity is not in the hand of corporates. It is not pre-decided. It's not fixed deposit. In fixed deposit, you and I as an investor know that if I'm investing 1 lakh rupees, I'll be getting 7.1%, 7,100 rupees at the end of the year. If we are not taking the monthly or the quarterly option, right? But in case of equity, it is not decided. It depends on the performance of the share. Now it is being traded on the stock exchange platform, National Stock Exchange, Bombay Stock Exchange. You might have seen the fluctuation in the price. One forces demand and supply. Higher the demand, the price will go up. Other factors are also there. Fundamental technical analysis are there by which we can determine. Sometimes you might see external factors. An external factor means systematic risk we are talking about. In case of any uncertain conditions, whether it is epidemic, whether it is pandemic or natural calamities or the global crisis, these all are impacting the return of equities once it is traded. So it's not only one factor, it's multiple factor. How the fluctuation occurs in the stock, that's what Joyce and I was just explaining. There are numerous factors. We can take systematic risk. If we talk fluctuation, we are talking about risk. Let me just take a plain slide so that I can write down your question and others can also feel connect. So fluctuation, and you are talking about how the risk and return is there. So I will broadly divide it and I'll quickly cover it because there are certain other subtopics also which I need to cover. So I'll answer your question. I'll quickly move to the next subtopic. So risk you are talking about, I will bifurcate into two. Systematic I will just mention the banking sector. Okay, let's say any stock is there which belongs to banking sector. ABC Bank. This is traded on stock exchange. Now, which kind of risk it holds? It has systematic risk as well as unsystematic risk. What is systematic risk? Which is derived from the market forces. That could be related to external features. External factors are there which cannot be controlled. You all are aware about the COVID scenario. So it was systematic risk. Entire market or entire the stocks were suffered out of it. It was not because of only one particular company. It was external factor. Global crisis, epidemic, pandemic, natural calamities, these all are considered as a systematic risk, which is uncontrollable in nature. Now, talking about unsystematic risk. Unsystematic is what? Let's say this ABC Limited is facing certain issues within it, within the company itself or the sector itself. Any policy comes which is not favorable for banking sector. Now, what is going to happen? The banking sector performance, then the shares of banking sector will go down. Any policy which comes which is favorable to banking sector, the banking sector stocks will move up. Now, unsystematic, one more example, let's say there is certain management issue, internal issue with this bank only. So what is going to happen? Entire market is not going to suffer. Only the performance of this bank is going to hamper. So this is unsystematic risk, which is controllable, which is within that company, management, labor issues, strikes, by which the performance is going down. It can be controlled, it can be sorted out, but here it is not. It can be avoided also. What I'm going to do if I have this stock, either we will sell it out, or if we have not invested in that stock, we'll not take exposure. So by diversification, unsystematic risk can be controlled and avoided, but systematic cannot. It can be avoided only by asset allocation, different strategy. I should not invest in entire amount into stock. I'll bifurcate in different asset classes and avoid this systematic risk. I hope I had given a very simple example so that you all can understand about what is systematic risk and what is unsystematic risk. Okay. Okay, fine. So example, these we had discussed in the previous session also. I'll quickly cover this. What are the different examples? What are the different investment decisions? So one is decisions on project to invest in. Companies might be having different options available to them. As an investor, I'll give example of personal investment also, so then you can easily correlate. Now, as you have different options, you will choose the option which is best for you, which will give maximum return to you. Here also, they have certain projects. They need to decide which project will be best for them. So decisions on project to invest in. Opening a new firm, we had quoted one example. They have presence in the South India and they want to open a new firm, new factory in North India. So opening a new firm as another option, another example for investment decision. Entering into new market, if in a company which are already existing in certain product. If they are into FMCG, they have in certain category. FMCG is a very broad category. So in that, if they are into one product and they want to enter into a new product or new market, that will also be an investment decision. They need to invest certain amount into that. R&D, different analysis will be done before launching the product so that if it is feasible or viable for them, what is the competitors, how much competition is there, then only they will get into that particular new market. So acquiring another business, that is part of M&A. That is also investment. Then R&D of new project, research and development. That is huge cost is involved into that R&D of new product and services. Right? It is not launched. Most of you can connect with this. For few examples, once any product was launched, the sample or the sachets were given free of cost to check the investor's opinion. Based on these survey, they make modification or changes if required. Or there are different categories also. For example, pharmaceutical company, R&D is being done for on different animals, then only the drug is being made available for consumers, human being. Maximizing return on capital investment. Any of the company, what they do if they are expanding, they are opening into a new firm, they are opening new firm, or they are entering into the new market. What they are doing, they are investing the capital amount. What is their target or what is their objective? Their objective is to maximize return. You as an investor is investing 1 lakh rupees. Would you be happy if you get at the end of year, you will be happy with 1 lakh rupees only, or 1,10,000 or 1,50,000? Obviously, the option where you are getting 1,50,000 or 1,40,000, that is the maximized return, which is giving you higher return. Risk minimization. Once you have 3 options, I'm quoting again the simple example so that you can correlate with the corporates. Let's say there are 3 projects, A, B, and C. You know that this project, how much the return based on the forecasting, how much return it is going to give you, based on the previous performance, historical data. You project the forecasting, you do the forecasting of cash flows and derive at a net present value. Wherever the net present value will be higher, that project will be viable for you, the invest project for the company. Similarly, if we talk about the investor perspective, you have three options through investment, three investment option. One is giving you 10% return, another is giving you 11%, third is giving you 13% return. Now, if only this matrix is there, return, you will definitely going to choose 13%. What if I add one more factor into it and I give you, it comes with very less return, very less risk. This comes with moderate risk. This comes with high risk. So once I add risk parameter also with this, you will definitely going to choose this. Most of you who are having moderate risk appetite will choose this project. Why to take additional risk and get only the 2% differences there? Or you can make it 12. If there is 1% different, but you are taking high degree of risk and getting. So for only 1%, if your risk is higher, you will prefer this project. So that is, we are talking about risk adjusted return. Now, return on capital employed should always be greater than cost of capital. Okay, this we had explained. Any doubt on this point? How much I had invested? I should get more than that. Okay, it should not be less than that. You have invested 100 rupees and you are getting 90 rupees, 99 rupees, you won't be happy. Okay, so return will always be higher than what is my cost. You have purchased certain item at 100 rupees. You will always be ready to sell it, which is more than 100. Less than 100, you won't be ready to sell. Okay, the normal conditions. So this return on capital employed should always be greater than cost of capital. My cost is 100 rupees. I'm getting 10% return if I'm selling it at 110 rupees. Right. Any question, any doubt related to any of the point which we have discussed? Yes, I can see some questions are, some answers are there in anonymous Q&A section. That also I'm reading. Abhijit, yes, 6-month running capital, short term, yes, fine. That can also be less than 1 year. Right. Okay. Any question? Okay, Paras, you have written risk will differ on the basis of organization. Yes, definitely. Different factors are there. A small example of maximizing return on capital investment. Okay, we'll take that question. Fine. At the end of the session, we will do certain exercise. Some example questions are there, Mohammed, then your doubt will be clear. Okay. First, we need to understand basic concept that is about the PV and FV concept. We'll take certain questions on PV, FV factors, and then we'll proceed to other questions. Right. So what are the different factors? Yes, cost of capital, Gaurav, will be WACC. Cost of capital includes both the things, cost of debt, cost of equity. So that is WACC, weighted average cost of capital. If the company issues the preference shares also, you will take that also into consideration. And then we will determine weighted average cost of capital. Okay, so what are the different factors? Capital budgeting, cash flow of project, and third is rate of return. We'll take one by one. First, we'll talk about rate of return. We always think about rate of return, which is higher. Every time as an investor, we feel the return should be higher. From the perspective of corporate, what it is cost. So they think that if this is less, it is beneficial for them. For example, they have two options of raising debt. One is 8%, one is 10%. 10% will be costly for them, 8% is cheaper for them. So rate of return, expected rate of return for us and cost of capital for them. Cash flows of the project, they are estimating how much they are receiving on during the entire tenure of the project. Let's say it will project has certain duration, 10 years. So first year cash flow, we will calculate net present value and we will calculate the internal rate of return IRR, so that you should be very clear with this concept. So here just understand about these aspects, cash flow of the project, any of the investment is being done. So it will start receiving certain cash inflows. They will start receiving, maybe by end of year, they will receive some amount as a profit. Next year, third year, fourth year. So these are cash flows for the company. So it will be properly estimated, and expected cash received and payments are made for the entire duration of that particular project. Now, what could be interest rate if we are talking about the debt in total investment amount? These all factors, if you try to correlate from the investment perspective, you can easily understand. If you are going to invest in certain investment vehicle, what you are going to consider. For example, you have 1 lakh rupees of investable corpus. You think about rate of return. You think about how much interest rate if you are investing in bond. What is my investment amount? 1 lakh rupees. If I'm getting 10% return from equity, I'm getting 8% return from debt instrument, 7.1% from fixed deposit. So based on my risk appetite, I'll choose which is suitable investment for myself. Not only the one factor rate of return. There will be other factors as well, which will be taken care of. My risk appetite, risk adjusted return, that is. Cash flows will be in terms of, let's say you are receiving certain inflows if it is available. Yes, Pooja, you have raised hand. If you have any question, just mention in the chat box. Okay, now coming to next part, which is financing decision. So first, firm has decided about the investment part. So investment decision is taken and they committed that new investment will be done. Now, from where they are going to get money? What we talk about? Financing. So many times we have discussed about the financing part, that is about the equity financing or debt financing. You can go through this PPT once, then I'll give you the brief idea about it. See, investment, they have decided now out of these 3 to 4 projects, I need to go for one project. Now what I have decided as a company, I have decided this is the project I need to take. But for that, whether it is expansion, opening a new firm, relocating, or investing in some other geographical location, it requires capital. It requires funds from where the financing will be there. 2 options, equity or debt. And then what they need to do, they need to build a mix of financing. Not the entire equity, not the entire debt. You might have heard about the capital structure. Capital structure of the firm is mixed of debt and equity. Debt and equity. It could be how much the ratio is, that depends on the various factor. It's not that, but yes, it is usually avoided that higher debt is always risky. Taking high amount of leverage is always risky. Okay, so capital structure, as we have just discussed about the mix of debt and equity, which is employed in a firm. Why? For financing, they have taken the investment decision. Now they need fund for operations. So this I was talking about how much percentage, like total debt and equity. 70 here you can see roughly 70-30, 70 debt, 30 equity, or 50-50. There is no ideal situation, but yes, it depends on the various factors. It depends on the corporate firms, their risk appetite, their cash inflows, and requirements as well. But higher degree of debt is always risky, because that comes with the default chances, because market scenario, systematic, unsystematic risk are also there, which cannot be predicted. Because before COVID, nobody was worried in like by December 2019, nobody has thought about this kind of situation where everything needs to be so isolated. All the operations should be restricted. There were so many companies or so many small firms and all which were just started but could not operate. So these are certain factors which needs to be taken care of by going this. Yes, generally Aryan, it is 2.2:1 only. But usually what we say thumb rules, these are the thumb rules, what we talk about 2:1. But in general financial conditions, we always stay away from these kind of thumb rules. It might vary based on the companies. Sometimes it is suitable for one company, sometimes it might not be fruitful, but might not be lucrative for other business. Right. I'll give one more example as you have quoted about 2:1, which is quite fair. But this is about the PE ratio. Most of you are aware about the price to earning ratio. Usually, as per thumb rule, it is said that more than 15 P is considered overvalued, less than 50 undervalued. So you should buy the stock which is at less than 15 P. But you can find so many companies just like Reliance, Nestle India, which are having very high P, then too it is being purchased. The demand for those shares are high. So it's not only the one criteria by which it is being decided that yes, this is the stock where we need to invest. So many of you are very active and you keep on typing in chat box. I feel it is very like pleasing for us, or I feel glad that you all are taking active participation. Joyson, the question is like if they need to start, whether they have owner's capital or another option is loan. So that is also restricted. We don't have that much amount to finance the entire business. For that, they go for debt option as well. Okay, so these are certain factors which are affecting the financing decision. We will discuss it in brief. Keep on going through the slide. If you have any question, you can just type in chat box. We will discuss that point. So cost of raising fund. Equity is generally more expensive than debt. Why it is called more expensive? One factor we had discussed, because debt comes with tax shield. Once the tax shield is there, that means it becomes less expensive as compared to equity. Equity expected rate of return is higher because risk is associated with it. I'll quote one very simple example. Let's say there is a firm ABC Limited. It has two options. One is the equity holder, one is the debt holder. So debt holder will always be demanding a fixed rate of return at that particular tenure. If they have raised for 10 years, for 10 years as an investor, I'll be expecting a fixed rate of interest, irrespective of company making profit or loss. Fine. So first situation is the parameter or the situation of debt holders or the demand of debt holders. Debt holders seek for fixed rate of return, fixed interest or coupon you can call. That could be less also, but fixed, irrespective of company making profit or loss. Now talking about the equity holders. Now those equity holders becomes the owner of that particular share. Now, if the rate on the stock market for that particular share increases, they will be having profit if they sell, or once it goes down because any of the reason, it is opportunity loss. See, there are two terms. Profit and loss are the two terms in terms of a stock, which I keep on reiterating. Usually, you might have heard from investors that I had purchased a stock at 100 rupees. It has reached to, let's say, 120. I am having 20% profit. One says I had purchased at 100 rupees. It goes to 80 rupees. I have 20% loss. It's not loss. It's opportunity loss. Loss will be once you sell it. It's not based on the current market situation. You are saying that it's my loss. Loss is once you sell it and the amount is credited in your bank, which is associated linked with the demat and trading. Fine. So two terms sometimes confused and used in interchangeably, which is not. It's not loss, it's opportunity loss. And actual loss will be once you sell it. Yes, Abhijit, you raised hand. Let me quickly take the questions. Yes, Girish, that budgeting part we will take later. But in brief, you can understand we are talking about how we are sourcing the money. How much portion is debt, how much is equity, how much should be return are expected by debt holders, how much return are expected by equity holders. By that, we calculate weighted average cost of capital. If the preference shares are also issued, then that will also be added in the WACC. Tax shield means let's say in debt, if you are borrowing money, what they do, what is the corporate tax rate? 1 minus T. The cost of debt, I'll write the back formula so that it should be clear to all of you. Cost of equity multiplied by rate of equity plus cost of debt multiplied by weight of debt 1 minus tax rate. Okay. So that is the corporate tax rate. Once you multiply it with the tax rate, the cost will become lower. It is cheaper for the investor, for the corporates. Okay. So this is WACC. Okay. Minimize the risk. Can we minimize the risk in equity? Yes, Manish, we can based on the risk appetite. That is completely total personal financial planning. In equity, the risk can be minimized by based on the risk appetite. Someone who is willing to take moderate risk, they should invest in that kind of instrument. They should take a judicious mix of, let's say, certain amount in bond, not totally going to the equities or one particular segment or high risky stocks. For example, they are investing into one particular sector. The entire 100% allocation is only one sector. That is highly risky. So mix of that too based on the different allocations there, based on the tenure requirement, their goal planning, everything will be taken care of. Not a random question, it's not a paracetamol which can be taken by everyone. Like usually what we do, some good fund. So good fund has a different definition. For me, it could be good fund. Other, it could not be. Reason being, let's say I have stayed in that fund for more than 6 years. So that is why it is good for me. But someone who entered at a wrong point of time and wanted to exit at loss, that is bad for him. So there is no generalized statement. It depends on the various factors. Entry, exit, tenure, at what time I have entered, how much allocation, once the market gone down, did I invested more? Many factors. Okay. Yes, Gaurav, it will be unrealized loss. Yes, Abhijit, it is for debt only. I'm just going through the question because few questions are available in this. Flotation cost is normal. Let's say companies are going for either issuance of debt or equity. So it includes certain cost. Cost of what? For IPO. What they do, a brief process we had discussed in the previous session. So flotation cost is the cost which is involved for prospectors, draft red herring prospect, underwriting fees. They hire the investment bankers. So investment bankers are not working for them free of cost. They are taking certain amount of fees, commissions for helping them, for uh, assisting them in the entire process of IPO. So let's take one example. If this is the amount, 1 lakh is needs to be underwritten, means they want to issue the share worth rupees 1 lakh, and they are charging 2% or 2.5% underwriter commission. I'm taking just a general example so that you should understand what is flotation cost. So for this, if they are charging 2%, the amount is like 2,000 is the cost. So, and if they're issuing money also, if they are raising via debt, that also involve the flotation cost, same process. Prospectus, DHRP, draft red herring prospect, SEBI approval, and all we discussed about those. So all these are the fees or the charges which are incurred. So that is the cost to flotation cost to that company. Okay, next question. Yes, Monisha, you only will be decided that you will become the equity holder or debt holder. Let's say LIC has come up with initial public offer. So if you invest into LIC and you get certain shares, you have invested that is long back that IPO came. So I have taken an example so that you should understand. So LIC came up with IPO, equity IPO. You have applied for that, you got the share. Now you become the equity holder. If the price of the LIC share increases, your profit increases. If that goes down, your it will become a loss if you sell. Now, another example, LIC has come up with the bond. They have issued certain bond, LIC Housing Finance, certain bonds they have issued. You have invested that. So you have invested in the bond issued by the LIC. The tenure based on tenure, if it is 10 years. So for after 10 years, whatever amount you have invested, you will receive that at end of 10 years, plus the coupon amount which they have promised to pay on annual basis. That is your return. Okay, next question is, who gets to decide this? The company decide this, that how much they want to raise. The capital structure will be decided by them only. Let's say you want to start a business. Now you want to start a business. So it's your choice how much you want to sell your equity portion and how much debt you want to raise. Flotation cost, Girish, I have given just one example over there. I think some of you have asked the same question. So flotation cost means there's an IPO size. You might have heard about the IPO. This is the issue size, 7,000 crore, 5,000 crore. So size of the IPO means this much amount they are raising. So that amount multiplied by the percentage fees charged by investment banker is the cost associated with that. They have certain selling lead managers, book running lead managers. So these all are what the parties who are involved to help them out in this IPO process. So this much is what as example of IPO cost, or that expenses, flotation cost, right? What is underwriting? For us, underwriting means investment bankers are taking risk on behalf of issuer. What they are taking risk? They are taking risk for what? Risk is they are selling the issue. If the issue is not sold out, the entire stocks are not sold out. So these are certain risks. 1 second. Okay. The next is underwriting. I hope it is understood. So underwriting in terms of insurance, what we say, the insurance companies are checking. The underwriter is there who checks whether the candidate is eligible for that particular policy or not. If they are not having that much income or they are not well, they reject the term insurance policy. Underwriting term you might have heard in terms of insurance. Here, underwriting is in terms of the shares. Let's say the investment bankers and the company. So the company wants the investment banker to help them issue shares. Now it is the responsibility for investment bankers to advertise, to sell the entire issue. If they are not able to sell the entire issue, then they will return the shares which are unsold to the corporate. This is between the deal only. There are few options of the underwriting, like all or none, full commitment. So full commitment means if they will try their best to sell the entire issue, but in case that some of the shares are not sold out, it is not purchased by public, it's not subscribed, the IPO is not subscribed, so they will give it back to the issuer only. So these kind of types are there for underwriting. Now next question is, it is possible to buy stock before IPO in demat account? No, in demat account, how will you buy? If it is public limited company, then only the IPO will come. First, it comes to the demat account, then you will be able to sell out. Yes, Karandeep, flotation cost will be borne by the company itself because they are taking help. They are appointing some, who are the investment banker? They are the mediator. They are the bridge between the investors and the corporate. So to whom they are helping it out? They are helping the issuer. So issuer will pay for that. Okay. I hope I have taken all the question. Any of the question is left? What exactly weight of equity means? Weight of equity means the total amount, total capital, equity percentage divided by total amount. I will tell you how weight of equity is. What is the total? Equity plus that means total value. So total value is 100. Out of 100, they have, let's say 50 equity. So the weight of equity is this. And cost of equity, let's say, is 11%. I'm taking a random example, Muhammad, to explain you. This is weight of equity. So weight is 50 out of 100. And if then again the debt will be there. So plus that will also be 50. If let's say it is 60, it is 40. Then this is weight of equity multiplied by the cost of this is 8%. 1 minus tax, if it is 20, 30, whatever percentage, this way we calculate well. Okay. Oh, Abhijit, that is different. We'll discuss that point later once we discuss cash equity. Otherwise, I can see some questions which are very basic, so they might get confused. Okay, I'll separately give answer for that. We can raise through ticket as well, or we'll discuss in cash equity section. That can be considered, right? Companies issues equity. If it is not listed, sometimes unlisted securities are also there that can also be bought. Fine. Any of the point in this PPT? Anybody? Okay. Now coming to dividend decisions. What is dividend? What do you understand by dividend? Sure, Mohit, sure. That's why I have come to next point, that is dividend. Profit of the company, right? Hmm. Okay, I'll quickly discuss about the dividend decisions. How many of you are quite aware about how to calculate dividend once you know from the perspective of shareholders? From the, as let's say you have invested in a company and you know about 400% dividend is being announced by the company. So how do you compute that? Just raise the virtual hand. From the perspective of investor, how many of you can easily calculate what is the amount of dividend company is paying? Profit share, okay. In the meantime, I'll just write the answers or read the answers which you all have mentioned for dividend. Distribution of profit, yes, profit earned by company. Distribution, it is, you have Shanti, you have written half of the answer, that is profit earned by company and they are sharing it. Profit given to shareholder is right, distribution of profit. Little bit of amount from profit of the company. And it's totally the discretion of company whether they want to announce or not. They might have earned the profit, but it's company's discretion whether they announce the dividend or not. Fine. So let's quickly finish this and then I'll come to I'll answer the question which I asked from all of you because nobody has raised hand how to calculate. So I'll give the brief of that. Yes, Abhijit, you raised hand. Fixed interest. Fixed interest paid to debt holders and dividend is not fixed. Yes, in case of debt or the coupon is fixed, but dividend is not fixed, right, Prachi? Annual dividend amount upon total number of shares. Aryan, you are right, but my perspective to ask, my question was different. This was from the profit divided by total number of share out, Ayush. This all you are calculating annual dividend per share upon price per share. This is right. I was talking about, let's say one company has announced 400% dividend. Okay, I'm writing it here only, a random example, 400% dividend. The price per share, current market price is 100 rupees. Face value of share is 10 rupees. What is the dividend per share? What is the dividend per share? I hope all of you have understood what I intended to ask. A company, ABC Limited, has announced 400% dividend. Current market price per share is 100 rupees. Face value is 10. Okay, fine. Some of you have given, what about rest? Yes, yes. Dividend is 40 per share. Right? Anybody who is having any doubt? This is the face value 10 rupees. See, once the shares are issued, it is a nominal value on which it is issued, 10 rupees. nominal value. It can be changed. You might find certain shares which are having face value of 2 rupees, 1 rupees. Why? So they split it. Initially, they have launched the shares with the face value of 10 rupees. So all the corporate action benefits are given based on this face value, not based on the current market price. Let's say we are talking about dividend. So dividend is not calculated based on this price. If I calculate 400% of this 100 rupees, it will be 400, right? So here it will be calculated based on 400% of what? 400% of face value. If the face value is 1 rupees, then the dividend is 4 rupees only. Irrespective of the current market price, these corporate action benefits are calculated on the basis of face value. Yes, yes. And how can calculate the dividend? I'm calculating here only. This one, as one of you have asked about how we are calculating let's take two example. One, the face value of this is 10 rupees, and you all have calculated the dividend will be 40 rupees in this case. So 40 rupees from where we derive 400% of 10 rupees. Okay, 400% of rupees 10. This is the dividend. If the face value is 1 rupees, then 4 rupees is dividend. Similarly, there are other corporate actions also for like split issue, bonus, how these all are decided based on the face value, not on the current market price. And face value means first stock listed at price, then after a split. Yes, Abhijit, right. How to calculate? No need to calculate face value. Abhijit, we need not calculate. It is given. Wait a minute. Wait. Let me stop sharing this. I'll take you to the site. Wait. Kevin, face value is the nominal value. Once the share are issued for the first time, there is a face value which is given, that is mostly 10 rupees. 10 rupees face value. All the calculation related to the corporate action is being done on the basis of this face value. Let me just stop sharing this. I'll share one more screen. Give me a minute. Wait. My screen is visible to all of you? Okay, fine. So most of you know about the moneycontrol.com. You simply go to moneycontrol.com, click here. You will find market. In market, you just go to corporate actions. Once you click on the corporate action, you will find the data related to board meeting, AGM, EGM, then bonus split, right issue, dividend, book closure. So these all are what? The corporate action. You will get the entire data. That too, complete detail from 2000 to 2024. 24 years data is available over here. You can easily check ex-dividend record, announcement date, everything. I can explain each and every point, but this I'll explain once we discuss about the cash equity part. Here you can see CRISIL and other companies like Castrol, AGI, they have provided the dividend. This is the 2,800%. That is based on the face value, not 2,800% on current market price. You can see the price and face value. What is the face value of this? Here you can check. This is 1 rupees. So face value 1 and then 2,800% means 28 rupees per share. The share is trading at 4,900 and the price what we have calculated based on face value, right? So this way you can understand which company has announced bonus, dividend, what is the date, announcement date, what is the record date. Yes, now just let me go through the questions. Anybody, any doubt? Any question related to what we have discussed? Okay. Just take 5 minutes break and then we'll continue. Okay. Monisha, company decides, the corporate decides. Okay, 5 minute break for everyone and then we'll start. I hope all of you are back from the break. Okay, Pooja. So Mohit, is it your first session? Mohit, are you there? You have mentioned that you didn't understand. It's your first session. Don't worry about that. It's your first session and you have missed 2 sessions. So what you can do, you can just go through recording of previous 2 sessions. Joyson, it's yours also. Whosoever is attending this session for the first time, I just suggest you to go through the first 2 sessions. Okay, but still if you have any doubt and query, you can ask me. You can ask me the doubt, you can write through ticket, you can ask me in the next session. All the options are there. Everyone who said, I can see Suvarna, most of you are attending the session for the first time. So 2 more sessions are there for the basics of finance. I had started very slowly. Okay, just raise hand. How many of you have received the recording in LMS and check it? Who checked the recording? Okay, Gaurav. PC and 4 other. Okay, so for all of you who has raised hand means the recordings are available. Okay, Abhijit, I'm writing my name. Some of you who have joined the session for the first time, for them, I'm writing my name over here, brief about my introduction. This is my name, Shilpi Shrivastava. I'm MBA Finance and CFP professional, having more than 11 years of work experience. This experience is in the finance industry with different companies, wealth management companies, broking companies, and bank. And since last 3 years, I'm investment banking trainer. Okay, so this was myself, introduction and names for others who have joined the session for the first time. Any point of time, you need any help, any support, you can connect me. You can ask the question during the session. Means if it is related to that topic, we'll clear there. Or if it is related to previous topic, you can separately raise a ticket. I'll respond to that. But prior to that, just go through the entire session. Okay, Prachi. Thanks for confirmation. That's what, Hitesh, we are coming into that, not whole proportion of profit, because once they share the whole proportion, that they won't be able to do justice with the future projects. They retain certain profit, certain percentage is only distributed as a dividend, the rest is kept, or sometimes they retain most of them to reinvest. Right. It is similar to like dividend reinvestment. Most of you have heard about the mutual fund, 2 options in mutual fund. Whether you are investing, you are going for the dividend option. Yes, Vedanta. So you are going for dividend option or dividend reinvestment, either payout or reinvestment. Although the name has been changed now, it won't, but the term is same. Like the crux is same about that mutual fund. That comes with IDCW, income dividend, come capital withdrawal. Right? Income distribution come capital withdrawal. This is the term which is used now for the dividend payout and dividend reinvestment. Fine. So that means what happens, I was just explaining one example related to that mutual fund. That means if the company is announcing dividends, there will be certain investor to whom they have opted for dividend payout, they will take it. For others, company has announced a dividend, but it will not be paid to the investors. That amount will be reinvested and the NAV will grow in case of mutual funds. So here is what they are reinvesting that amount, and definitely the company, they are having business, so they will earn more amount, more return out of that reinvestment amount. So every time once we see the earnings are retained, that is also beneficial in certain aspect, because the returns which a company is getting, that reflects the share price, reflects in the share price. Yes, Ronak, it is face value is, it is also termed as the nominal value. Nominal value, which is mentioned, for example, in case of bond, we say face value. What is face value? Par value or the nominal value of that bond, 10 rupees or 1000 rupees or 100 rupees. That is the face value. All the calculations are done on the basis of face value. Coupon is being calculated on face value of bond. Here in terms of shares, corporate action benefits are given. Okay, that is for big maintaining into the books, 10 rupees face value. Once they split the share, P price earning ratio, Abhijit, price to earning ratio. Price of current market price of share divided by earning per share. We'll discuss that later. Now, let's quickly focus on the dividend decision. Coming back to this part. So we have discussed so far about the two decisions, investing and financing. Now, third is the dividend decision, which is one of the most important decision. Here, what the companies do, they are sharing their profit with investors. Who are the investor? You and I, who have invested in that company, and we are also have owning our share in that profit which the company is earning. So here disbursement of profit is what? A dividend. Now, okay, it is concerned with how much amount needs to be distributed among shareholder. Let's say they have made a profit of 1000 crore. So entire 1000 crore will not be distributed as dividend. So they need to decide how much they will distribute to shareholders and how much will be retained, how much will be further invested. So here two components are there that will be discussed. We'll discuss distributions of earning. Here, what company can do? Company can distribute the earning to shareholder in the way of dividend or share buyback. This is one more term. First, we'll discuss about the dividend and I'll explain this later. After completing the dividend option, we'll come to that share buyback. A company can retain the excess earning for future investments and operational requirement, which we have just discussed. They haven't announced dividend, they haven't paid the dividend. What they have done with the profit which they have earned, they have reinvested that profit. Okay, so what they are doing, they are retaining the earning for future investment and future operational requirement to earn better return out of it. Now coming to the share buyback, what is share buyback? You might have heard about different corporate action. This is one of them. The companies buy their shares back from the investors. If the price is, let's say, at current market price of that ABC Limited is 100 rupees and they want to buy back the share. So they will offer higher price than at what is trading at stock exchange. So what they are doing, they are increasing number of shares. They are increasing their shares and they are buying from the investors, which they have already issued. Yes, Urvashi, 1 second. You want me to go back to previous slide? Just quickly check. Don't worry about the part which is written on the slide. You can anytime discuss with me. And the second thing is, in PDF, it will be mentioned as a book form. So you need not worry about noting down. But yes, if you are making notes along with the class, that will be best practice. Okay. Joyson, what you want me to repeat? You have mentioned you are talking about buyback share. Want me to repeat buyback one? So buyback is, let's say some company, ABC company has issued certain shares. Now what? It is traded at the stock market. I will give you an example and write it here. Urvashi, I think you are done. Now I'm telling to. No, Gaurav. It will be reduced. It will reduce. Reason being, how it is going to work? Because that is going back to the issuer. This is issuer, let's say ABC Limited. They have offered certain shares via initial public offer. Now, what it is trading at 100 rupees, for example, at stock exchange. Now, company announced a buyback of share. So usually if they want to buy from the investors, usually the communication is through via mail, via postal ballot to the investors that this is an offer of buyback, and the investors, if they wish, they want to sell their shares, the price offered to them will be higher, let's say 110 rupees or what, something which is higher than current market price. That means they are going to increase their capital and they are reducing the issued capital. Okay. See, Paras, at a time, what you can do, just now we have discussed, we have seen moneycontrol.com. You can do a proper analysis of this. You can make chart of the number of companies which gone for buyback and the price quoted for buyback. Even just give me certain time, I'll give the example in our next session, maybe coming Saturday. We'll make a table and provide you certain cases where you can see the buyback. Or if you or any one of you are willing to take this assignment, you can do so. Just make a list of the companies which has gone through this buyback offer and at what price, what is the change in price, at what price it was trading at market, what was the offer price. Okay, Arjun. So we can do this exercise and we can discuss in the live session as well, right? Yes, promoters are increasing their own capital. This is like just opposite to offer for sale. What happens in one more corporate action, OFS? Most of you have heard about OFS. That is offer for sale. In this, what they do, promoters dilute their stake in a transparent manner. It is available for on NSE and BSE to offline and online, where they sell more shares. They dilute their shareholding through OFS mechanism. Here also, this is complete within the regulatory norms, how much percentage is fixed for the retail investor, for different category of investors. It is completely fixed based on the SEBI purview. Regulatory norms are followed in these all corporate actions. Wait, Abhijit, we'll discuss your point as well. First, distribution or earning, we'll discuss this, and then your example will be discussed. As you have written, if the dividend is provided from profit, then why after disbursement it takes like giving 5 rupees dividend and price? It happens. It is the usual scenario once any corporate action is there. Let's say company has, so the amount is what? This is cash outflow only. From there, total amount, only the amount has been disbursed. So this is trend whether you pick any of the stock. We have just checked the list in moneycontrol.com. You can check any of the stock once they announce dividend and thereafter. After within 1 week, you can see the price. Price will always be declined, whether it is dividend, whether it is bonus issue, or in terms of, let's say, split issue. You can check these trends. And I have made certain examples related to this right issue and all. Maybe next, once we complete this session, I'll share it with you. Certain example of the real stocks which have gone through this right issue, which have split issue and all, how the price has been changed. Right. Okay, now distributions of earning. This we had discussed. Company can retain excess money. Now, what are the different factors which affect the dividend decision? I'll take one by one. We'll discuss this. First is preference expectation of shareholders. That means there are different category of investor. One category of investor who choose the stock based on the dividend aspect. That means they select the stock in their portfolio which is continuously offering the shares. Earlier, this criteria was more considered more. Reason being, once the dividend was tax-free in the hand of investor. But nowadays it is added in the income, so it's not that much prevalent. But earlier the main factor was, since its dividend is tax-free, so most of the investors like senior citizens and one particular category who look for this tax-free investment, they wish to invest in the stock which has a previous track record of providing dividend on regular basis. So preference and expectation of shareholder means the category of investors who look for dividend option or regular income. Also, you can take one more criteria. Who look for regular income, they will pick certain stocks which are having the continuous history of paying dividend, so that they can earn return out of their profit, at least minimum amount, certain percentage as a dividend. Stable earning of organization. What that means, if what is the earning of that organization? If they are not earning, but they need to provide the dividend, what is going to impact? Is it going to impact their profit? Yes, it is. So until unless they are having the stable earning of organization, they won't be able to execute this option Now, that these two points can be clubbed together: dividend stability or stable earning. Once the earning is stable, they will choose a decision to provide dividend. And once the stable earning is there, they can provide a stable dividend as well. Taxation policy: high tax, lower dividend payout, or low tax, high dividend payout. These could be certain factors which might affect the dividend decision from a corporate. Growth perspective, higher growth perspective, they will always allow low dividend. Reason being, each and every investor, as you prefer the example which we have taken, a mutual fund example. Two options are there: dividend payout, dividend reinvestment. Most of the investors prefer dividend reinvestment because they feel if that amount is reinvested, they can get higher return as compared to once they take the return. Here also the example explanation is quite similar. So high growth prospect, low dividend. If the company is looking for high growth prospect, they feel the amount which they are distributing in dividend, if they retain that amount, they can make more return out of it. If they distribute it to investor, that will be reduced, the total corpus will be reduced, and the higher the growth prospect will be minimized then. They should have a sufficient cash flow to provide this dividend, because that is also reducing from the company's total corpus. One second, I'm just taking one question after a week or a day before dividend. So that means 5% drop. 5%, the example which you have quoted, I can see the 5% drop in the prices. And how much is the dividend provided? If it is 5 rupees per share, then it suffice. It is equivalent. That is same. See, 5% is what the example which you, I'll just give the example. One of your colleague has mentioned the question about one share which has announced a dividend, and the price of the stock was 100 rupees. And after dividend, it was 95. On dividend day, it was 95. That means they announced and 5% dividend is being given here. The price is also reduced by 5%. Anyhow, it is same. So earlier also, once the investors are keeping practice about the dividend paying stock, but in a nutshell, what happens? The price was almost same. They are getting some amount as a dividend, but the cost or the current market price of that stock has also reduced by this quite similar amount what they have received as a dividend. So the only benefit which they were getting at that point of time was tax-free in the hand of dividend, but now it's not. Okay, so we have discussed about these all points. Now dividend and buyback. These are the differences. One second, I'll just explain about few points. Dividend, one time or ongoing, you can say annual dividend one time, or ongoing interim dividend, final dividend. You can see different category which we have just seen in moneycontrol.com. Now contribute to yield on the stock if ongoing regular dividend. Yield means the return. Yield means the return which includes these regular payment as well. If I need to calculate yield on my stock which is giving me dividend, that I'll calculate through different method. If the stock has not given dividend and I have invested certain amount, after 3 years I receive Y. I have invested, let's say, X amount, I received Y amount after 3 years. In between, I haven't received any dividend. So I'll simply calculate the CAGR for that. Now, next is another stock which is giving me ongoing regular dividend. For that, I need to calculate XIRR to find out the exact yield. We'll discuss one example of yield once we are doing it on Excel. Number of share outstanding will not change, or earning per share is not going to change once the dividend is announced. No impact on shares outstanding. That simply means, how do we calculate the market cap? Market cap is equal to number of shares outstanding multiplied by current market price. So now what? No impact on share outstanding. This will remain same. Current market price will be reduced. If the current market price is reduced, then the market capital will be reduced by a little bit, not more. There will not be very huge difference of market capitalization after the dividend decision. Okay, now coming to EPS, earning per share will also not be change. There will be no impact of dividend decision. Now, buyback was the another option, reduces the number of share outstanding. Here, what is market capitalization? Let's say for Reliance, if it is 17, 18, or I think 21 trillion. If I'm not wrong, you can cross check this. More than 20 trillion is the market capitalization. So now what? In case any company wants to go for buyback option. So that simply means they are reducing the number of shares outstanding because they are purchasing it from the customers. They are purchasing it from the existing shareholders. Okay. And once they do it, it increases the earning per share because the more number of shares are with the company itself. It is not with the shareholders. So if anybody asks you about the impact of dividend and buyback of shares, then you can explain these 2-3 important metrics, how it is going to impact number of shares outstanding, how it is going to impact the earning per share. Okay, what is the nature, like it is ongoing, and how it is buyback, how it is being applied, initiated by corporates only. For getting dividend any time period, yield point, wait. There are two questions related to this. I'll explain both one by one. For getting dividend, any time period is there? No. See, Manish, your question is for getting dividend. No time period. You should be holder of that particular company on the record date. I have just shown you that money control table, which is having different data. That is record date, X date, announcement date. So that means if you have the shares in your account on record date, you are eligible to receive that corporate action. If shares are not available in your demat account on record date, you are not entitled to receive that dividend or any of the corporate action, right? I hope I'm clear. Prachi, yield I have explained you. For example, two cases we can see. One is, let's say you have invested 1 lakh rupees in particular share that has increased to 1.5 lakh after 1 year. Okay, so this means 50% return. I'm holding a hypothetical situation. That means your CAGR is 50% because we are talking about one. Had it be 3 years, we can easily do it in Excel. Now, talking about within 1 year only, the company has given the dividend twice. On this 1 lakh, it has given on this particular date, another particular date, maybe after 6 months of your buying or 3 months of your buying, then again after 6 months. So you will put the particular date here, and then you will calculate XIRR, which gives you yield of that particular investment, which is giving you dividend. Because here the intervals are not regular intervals. Sometimes it has decided after given you after 3 months. Here it has given after 4 months. Date will be different. So exact number you will find here. Okay. Now, buyback is, Manish, buyback is simple. One of you is asking to explain buyback again. Let's say ABC company is there. It has come up with IPO. The shares are listed now on the stock exchange. Now the share, let's say, is trading at 100 rupees. Company wants to buy back the share from the investor. They want to increase their amount, their number of shares. They want to reduce the total number of shares outstanding in the market. Getting my point? So that simply means, okay, if I want to make it more simple, I have started a company and sold certain equity share, made it public, that is available to initial public offer. I have sold out, let's say 20%. So 20% is with the equity holders. Now I intended to buy shares from public, that is a buyback. A company wants to buy its own share from the shareholders is the buyback. How they do this? This is one of the corporate action. It is announced by the exchange. You get the information through the mailer, through exchanges as well. What the company is doing, it is reducing the number of shares outstanding. They are increasing their own percentage shareholding. That means the further chances for the company to grow will be higher. That is why they are taking their shares back. They might be investing in certain projects which might be more profitable. And they might be having certain other plans. Okay, you can take some buyback case studies and understand it in a more better way. Now, retention ratio and dividend payout ratio, these two aspects are there once we talk about the dividend decision, more important aspects. So now I'll open the slide at one go and then we will discuss here with the help of example. Now, retention is what? What do you mean by retention? You are retaining something. So here also retention means they are not distributing, the companies or not distributing the entire profit. They are retaining the earnings, proportion of earning which is retained by business rather than paying it to shareholder as a dividend. They are retaining out of 100, they have distributed only 20%. So that means how much they have retained? 80% is retained. This one is distributed, this one is retained. You can take any example. To make it simple, I have taken this. This much is distributed, this much is retained. Okay, so what is the retention ratio? Retained earning divided by net income. If the total income is 100 rupees and they have retained 80, so that is retention ratio, 80%. Or how do we calculate retained earning? Total income minus dividend distributed. Let's say they had 100 crores, they have distributed 20 crores. What they are left with? 80 crores, right? So retained earning 80 crores, retention ratio 80%. Got it? Simple to understand because we have taken very simple example for this ratios. Any doubt, any question? Abhijit, there are different factors. See, we cannot comment as a generalized situation. You can go through certain case studies also. There are different situations when you find there are certain loopholes, there are certain criteria which can be considered under red flag category. Okay, so here we will discuss about the fair situations. Okay, now coming to the next aspect, since we discussed about the retention ratio and retained earnings, how do we calculate the retention ratio? Now coming to the dividend payout. Similarly, as you calculated the retained, you will get to know about the dividend payout ratio. Total amount of dividend paid out of shareholders related to net income. Okay, this way annual dividend divided by net profit will give you dividend payout ratio or 1 minus retention ratio. 1 minus retention ratio will also be same dividend payout ratio. Like 1 minus 80% is 20%. Right? Any doubt, any question related to this aspect? Anybody? Okay. So for this part is clear to everyone? Just raise virtual hand if it is clear so that we can do one exercise. Okay, clear. So just take this. Based on below mentioned information, you need to calculate the dividend payout ratio and you will write your answer in chat box. ABC Limited has paid a dividend of 240 crore last year. It has net income of 600 crore and the retained earnings are 60%. You need to calculate dividend payout ratio. What is dividend payout ratio in this? Okay, all of you have done. Two ways to do that. 1 minus payout ratio, 1 minus retained earning. That will give you or about the dividend divided by net income. So here the dividend is 240 divided by 600. This will give you 40% or 1 minus 60% will also give you two ways, right? I'll just do it here only. So this is annual dividend paid, 240 CR divided by 600 CR. This way you'll get 40% multiplied by 100. And the next is 1 minus 60%, 40%, right? Two ways. Right, so most of you have written in the chat box, all correct, all right. Right? Okay, now there are different techniques about valuing a business or valuation of investment. What we do at initial level, NPV and IRR. NPV is net present value. We calculate the net present value of all the future cash flows which will occur over a period of time for that particular tenure of an investment. This is similar to DCF, discounted. You are discounting the future cash flows and arriving at net present value. All things are same. Once you calculate it in Excel, you will find the easy way or multiple ways of getting this DCF. Okay, so why we are doing this, whether that investment where we are investing is worthwhile or not. So for that, company try to evaluate the project or differentiate between 2-3 projects, which one is good. IRR is internal rate of return. That means how much that particular project is going to generate as an annual rate of return, that compounded annual rate of return. So based on that, which project is generating higher rate of return will be feasible or viable for that company. And similarly for the net present value, the value which is higher, in which project the NPV is higher, that will be considered. Prachi, which example you didn't understood? Are you talking about dividend ratio? Okay. 1 second. I'll just repeat one example of that dividend which she didn't understood. So I'll explain for her and then come back. See, the question was ABC Capital Limited has paid dividend of 240 crore last year and net income was 600 crore. So what we have taken, the formula was what? The dividend paid, annual dividend paid. So what is the annual dividend paid? 240 crore divided by what is the net income? Net income is 600 crore into 100. Fine. This is 40%. Another formula was 1 minus retained earning. What is the percentage of retained earning? So dividend payout ratio equal to 1 minus retained earning. 1 minus 60% will give you 40%. So both the ways, this is 40% and this is 40%. Got it? Okay. Fine. So we were talking about relevance related to net present value and internal rate of return. We are valuing an investment or for not only for the projects. Let's say you need to invest certain amount. What we do, you analyze which instrument is going to give you higher return, right? Let's say you are having certain investment which will give you annuity. Annual return will also be there. So you will calculate cash inflows are for the particular specific period, this amount you will receive. Based on that, you will arrive at a present value of those all future cash flows for that entire time where you are investing. Let's say you have invested in an annuity plan for 10 years. So how much inflows you are getting, cash inflows, based on that, you will calculate what is the rate of return you are getting, whether it is feasible or it is less. Then only you will decide that yes, this is a good project to invest, good investment vehicle or not. It suits your requirement or not. Now, see, NPV IRR will calculate in Excel. Today, we are not going into that detail because I said that I will cover it from the beginning because some of you have raised hand that they haven't used the Excel. So very basic about the Excel and then we will start doing it. So tomorrow, if you all are ready, what you can do, we can do the calculation part along with each other, right? So you can use one Excel sheet, you can open along with the session and you can try doing it. Then you will find out how easy or difficult it is. You can ask the question immediately. And we can do it maybe 1 or 2 times for the same problem. That is also fine. Not an issue. So NPV is what? Value, as I have talked about, the DCF means you are discounting the future cash flows. Whether you use NPV or you use that function through which we are calculating cash flow. How we calculate cash flows? Present value of all future cash flows. Cash flow 1 divided by 1 plus rate of interest to the power. This is for first year plus second cash flow 1 plus r to the power 2. Similarly, cash flow 3, and this way you keep on discounting it for n period, and you will add it. That will be total value of total present value of all the future cash flows which will occur. And you can do it through NPV function also, which we'll do tomorrow. Simply type equal to NPV, and Excel function is there that will quickly give you the present value of all cash flows. Yes, today is Saturday, Manish. We will have classes for both days, Saturday and Sunday. Same timing, 4 to 6. Wait a minute, Priyansh. So what I'll do, I'll ask the team. I had already shared the PDF with them. I'll ask them to upload the PDF, right? The entire session PDF will be available to you. I'll just mark them a message so that they can upload in your LMS. No worries. I have already shared. We'll ask them to upload it along with the recording only. So maybe before tomorrow's session, you all will have it. Okay. Till now, is there any doubt? So why on how we are going to use NPV, net present value method for capital budgeting, and we are analyzing the profitability of investment or a project. As I have discussed about one example of investment, you have different investment vehicle, different instrument available for you. You simply calculate the net present value of that. Then you find out whether it is giving better return or another option is giving better return. Based on that, you decide which one is profitable for you. Similarly, companies also decide based on these methods. Okay, so we'll do one. No, this exercise we'll do tomorrow since we have not done any Excel part. So before I end the session, I would like to take questions. If there are any questions related to topic which we covered today, subtopics, just let me know. Yes, Ronak. In these kind of exercises, this kind of examples, cash flow will be given. Then only you will be able to compute. So for the beginning sessions, we will have simple questions related to calculation related to PV, FV, and then NPV, IRR calculation. Gradually, once you go through financial statement analysis, and then the practical aspect related to DCF will be discussed. Initially, it is the base building part or the foundation. Okay, so that conceptual clarity should be there. Okay, since a few minutes are left, I think 5 minutes are left, and I don't want to start with this calculation part because calculation part will start by tomorrow by giving you first some basic example, and then we'll come to NPV and IRR function. So what I do, I will just share with some of you who have joined for the first time. I'll give them a brief idea about how we are going to proceed. So roadmap I had shared, most of you have gone through the webinar sessions which were conducted on first 2 days. Who have not gone through, please just check those sessions, go through that. If you find any problem, you can discuss with me. The second part is what I have discussed. These are the 2 months sessions, like first 2 months, few modules will be discussed, then months, certain modules will be discussed. After completion of each and every module, there will be practice test assigned or the test assigned, which will have nearly 50 multiple choice questions, which will be based on the topic only, which we had discussed, right? So after completion of each module, let's say we have completed basics of finance. So by tomorrow, if we finish basic of finance, next week you will get this test aligned in your LMS and you need to attempt it. For that, you will get proper mail communication from the team. They will let you know once the test is open and how to take that test. Only multiple choice question. Thereafter, gradually, some more tests will be assigned based on the modules completed. Okay, there will be some theoretical test also, but that will be on the later stage. One second, let me just check the message in the chat box. No problem, Manish. That will be applied. Maybe that will be reflecting by tomorrow. Okay. Joyson, I'll instruct the team. I'll tell the team to upload the PDF. Maybe that will be available in the LMS by tomorrow. So you can very well go through that. No issues with that. Yes, Rona. Face value, the value of shares the first time it came out. Yes, the nominal value, which is once it is issued first time, usually it is with 10. As in mutual fund, what happens? The NAV is 10 rupees once new fund offer comes. NFO comes and for the mutual fund, it is with 10 rupees NAV. Similarly, for the face value of the stock, we can simulate that and for the better or simple understanding. Okay. Fine, I hope there is no doubt and everyone is aligned with the session, right? So, fine, that's all for today. We'll discuss all the Excel related concept by tomorrow, right? Have a nice day, everyone. Test Apurva will, once the test will be aligned, we'll discuss before test. I'll inform you. Everyone will be understanding the what are the basic things. We'll do certain questions based on that. Similar questions will be there. Okay, no worries. Thank you, everyone. Thank you and all the best. Thank you. I'm ending the session. Thank you, everyone. Thank you.